Okay. I want to thank everybody for coming to the seminar today. Make sure that your cell phones are at least on vibrate. My name is Mark Gilbert. I'm with a firm called Elko and Associates and Advisories. We do both accounting services and advisory services. We've been in business for over 52 years. We've been specializing in the alarm industry. We handle financing, merger and acquisition, due diligence, outsourced accounting, consulting from an operational financial standpoint. So we've had the pleasure of sponsoring the business tracks this year and being part of ESX. With that, I'm not going to waste a lot of your time with Elko and Associates. I want to introduce Martha Entwistle and let her get this thing moving. Thanks.
Hi, everybody. Hi, everyone. Can you hear me? All right. I'm Martha Entwistle. I'm editor of Security Systems News, and you are at New Financing and Debt Options for your company, crowdfunding, high-yield bonds, and more. And I'd like to introduce today's speakers. We have next to me Jennifer Hollowell, who's from the private bank. And next to Jennifer is Robert Shevitz, who's with Aegis Capital Partners. And then Jeff Kessler on the end with Imperial Capital. What we're going to do is we're going to talk about some different financing and debt options. Everybody's going to make a short presentation, starting with Robert, and then we're going to open it up for some questions. However, if you have questions, during the presentation, feel free to just, raise your hand, and we can, we don't have to do, we can do questions along the way. So, here we go, Robert. Sorry about that. Booby trap there.
So just how do I drive this here?
Just this one right here. Sorry, there we go.
Okay. Well, good afternoon. It's a pleasure to be here. This is my 33rd year in the venture business and 20 years of actively investing in the security industry. I had the good fortune 20 years ago to back a team to build Protection One, and we took that from 30,000 homes to a little over $1 million and change by the time we sold it to Western Resources, sort of one of the utilities that felt they needed to be in the security business, at least at that point in time. And about 5 years ago, decided to focus exclusively on the security business as an area for investment, most of it later stage, and created a fund, Aegis Capital Partners. Fast forward, we were participants in the spin out of Alarm.com from MicroStrategies, and just last week we're part of a group that bought Mercury, the access control panel folks. So security is an area I really, 80% of my time I spend focused thinking about security technologies, and how that all works with finance. So hopefully this will be insightful. If I can figure out how to
Just hit the return right
here, there.
there, yeah.
Am I going the right way now? Okay.
There.
So I think that's really critical if you're looking to finance your business, if you're looking to participate in financing a company, is to really understand what stage you are as a venture. And one of the beauties of the U.S. financial markets is that they're so deep, they're so rich, and they're so segmented. The most important thing, I think, is understanding the definition of where your business is, so that you're addressing the right financial markets and the right audience for your investment opportunity. So the concept stage is really just that. It's a concept. You've got sort of thoughts about a business model. You've got an early team assembled. It's yourself, and maybe there's 2 or 3 others who've said, I really see the vision for this business. I understand exactly what mobile phones implication might be for residential alarms, for instance. Market identified. Is it commercial? Is it residential? Is it for the consumer? Is it for the professional? Sort of a sense of the competition, who are you going to displace? And again, it's all conceptual, but I know if I come with this product, if I come with this service, I could potentially displace ADT. Wouldn't be the first time. And then, God, I hope there's nobody from ADT here. And then just, I think in your own head, how big this business can be. And at this stage, the audience for this is typically going to be that proverbial friends and family who know you, can understand your passion for the business, understand your historical involvement in the business to get you to this point. And it's also a stage where the friends and family has been extended by virtue of the internet and by virtue of crowdfunding. And crowdfunding is pretty simplistically using the internet to extend the friends and family who view an opportunity at this stage to get on the ground floor of the next Google. I can't imagine how many times that's been said that this is the next Google, but that's really what crowdfunding is all about. And there are several platforms to use to reach that audience. The most well-known is a crowdfunding platform called Kickstart. And Kickstarter has probably raised hundreds of millions of dollars. And I know for a fact that not a lot, but there's been a fair number of companies who've raised money in the security category. In that pre-revenue stage, so now you're past concept, but maybe you can demonstrate the technology and how it works. You have proof of concept that in fact the technology or the market is interested in the product or the service. You've got customer input. I was involved with a company called FreightWatch. FreightWatch did shipment tracking and hijack prevention. Eventually we sold the business to United Technologies. But we had a tremendous amount of input from the Dells and Intel and Pfizer and Merck about what they needed for safety and protection of their shipments. And that ultimately went into what was a successful product. Beginning to understand your cost, what does it really cost to implement that service or to build that product. And then you probably at this stage can't really hire salespeople, so the sales are going to get done by the founder. And again, I think the audience for this goes from friends and family, crowdfunding, and probably some of the early stage venture funds that are established with a mindset that they want to actively get involved and make investments in companies that are pre-revenue. And there are those who understand that that's their niche in the world. There's also a recent phenomenon, just show of hands, I'm just curious, how many people are familiar with accelerators? All right, well, we got one participant, but good. So I'm actually an investor in one accelerator and a mentor in another one. So accelerators are basically wall-less incubators of concepts. So there's a group called TechX, there's a group called Y Combinator. Y Combinator has literally generated billions of dollars of value. They have a business plan contest. Out of those contests, 10 companies get selected. At the time they get selected, they'll get $50,000. That $50,000 basically pays expenses to be mentored for a 3-month period by people who have good, strong startup experience. A lot of times these accelerators are associated with universities. And the security company that I'm currently mentoring got accepted out of a universe of, I think, 300 applicants. They were one of 10, and the only one taken from outside the state of California for a group called TechX. 85% of the graduates of TechX raise $1.5 million or more. It's a really impressive audience to address at this stage. So if you identify an accelerator, there's probably 1 to 5 accelerators in every major market. I'd say every university at this point has one. But in Northern California in particular, there's literally billions of dollars being generated by audiences of very smart angel investors and early stage venture funds that appreciate that somebody who's gone through that process of 300 down to 10, 90 days of mentoring by, not me, but really smart people, are really interesting prospects for companies that can be successful. At the stage that you've got revenues, you've got those proverbial early adopters, the proven value proposition based on real customer spend. You've got your margins that are understood, the completion, or competition, I should say. That's horrible. It's clear. So those are venture investors that are going to be at that Series A round. They'll see this kind of revenue traction. They're used to investing in companies that are before profitability. Pre-profit companies are companies that have got good, strong revenue growth. You can understand the sales cycle, what it really costs to get a customer. The margins are very well understood. The gross margins don't cover the overhead, but they're starting to make a contribution in a way that it's really easy to do the math. So at 1,000 customers, I've got revenues, I've got good margin, but I'm not covering overhead. I get that to 10,000 customers. It's a very profitable business. And that's where you'd find your Series B investors. And that's a very deep market. That's a multi-$100 billion market. And people are very comfortable in writing $5 to $50 million checks to invest at that stage. And then everybody shows up for this stage, the expansion stage, where you've got revenues, you've got profits. It's really just a question of doing it more and enjoying it more. So you've got a proven business model, you've got revenues, you've got profits. You can clearly lay out the math in a very detailed model that the capital required for accelerated growth. There may be acquisitions that you want to make to accelerate your growth. There's expansion of your sales, and so you see the productivity of 5 to 10 sales, and so if you can take that sales from 10 to 50, if you can go from national to international, and it becomes a situation where, based on your current business and based on your an infusion of capital, you have predictable cash flow. That is the deepest of the private equity markets, and that is literally everyone who's doing Series B, Series C kind of investing to the private equity funds that will do increasingly not just change of control buyouts, but growth buyouts and expansion stage financings. And this is routinely a $20 to $100 million investment opportunity for people. So in short, what I would say is I think that it's really understanding what stage you're in and matching the audiences. I think the audiences are bigger, deeper, smarter at the early stage end than they've ever been. If you don't have any friends, if you don't have any family, it's okay, because I think the combination of crowdfunding and certainly the advent of these accelerators are creating the opportunity to take really good concepts with really dedicated people and find them a path to capital. So that's mine.
All right, thanks, Robert. Thanks, Robert. All right, Jennifer, you're next. Sorry.
Hello, Jennifer Holloway. When Martha asked me to join this panel, she asked that I talk a little bit about the private bank, a little bit about myself, and how a security company could prepare for bank financing. So I won't go over the stats. If you have a burning desire to see what our capital ratios are, this will be posted online. But the private bank's a Chicago-based bank with $13 billion in total assets. We focus on serving the middle market, primarily private companies and their owners, with commercial banking and wealth management. I'm part of a specialty lending division within the private bank that focuses solely on the security industry. This is all I do, just security. Wake up every morning, just thinking about the security business. And I've been doing it for 18 years and I still like it. So, we have a great team. In our division, we have 22 clients representing about $400 million in commitments to the security industry. And it ranges in the size of loans that we do. We do have the full support of our senior management within the private bank, which makes getting deals done, easier. It helps when they understand that, we have a real focus on security. So they've come to trust our experience in this area. So for a relatively small bank, we do provide some pretty deep treasury management services for RMR collections from small companies with a few thousand of RMR to our largest with 10 million in RMR. So my background is really providing financing for the last 18 years. I used to think that seemed like a long time, but it's nothing compared to some folks who might remember life before the digital dialer. So, I really enjoy it. My experience covers financing from a variety of market segments, from growth capital, and also for acquisition financing or leverage buyouts of partners. And then the different kinds of companies, whether it's resi commercial, security alarm. We also have a focus in the medical alert space, so PERS. As far as my background, I'm a little bit probably different than some of the bankers. I actually have operational experience through Protection One and through several other groups that I've been involved in both managing RMR portfolios, buy and sell side of acquisitions, of retail rate, of wholesale central stations. So I have kind of a different depth to my experience than you typically find in a banker, but I really enjoy the industry. So, I love the technology and love meeting security companies because everyone's different. So, as far as some of the things that you might need to prepare for getting bank financing, while you probably have success in raising financing through a local bank, it's probably not RMR driven, RMR based funding, if you will, that specialty lenders look for. So the private bank in our specialty division is an RMR lender. So we treat RMR like a financeable receivable, collateral similar to equipment or AR or inventory, but it makes us different. So I want to give you a little flavor for the industry-specific due diligence that we perform on companies. Because it may be different from your existing bank relationship if you're with a local bank that's not really focused on the RMR portion. So before we enter into a credit relationship with a company, we conduct our due diligence. We do most of that work on our own, but we also ask third-party providers like Elko to perform on-site field work to really look at a few things, namely the collateral or your RMR that's going to support the debt, and also your financial systems that we'll rely on to validate that your collateral is there month after month. So as you get into RMR, some of the things that we ask is your RMR marketable? If the worst came to the worst, is there some way to liquidate the RMR on the secondary market to repay the bank debt? Are your monitoring margins comparable to your peers within the industry? And then can your financial systems produce RMR roll forwards something that we rely on as an RMR lender is, seeing how many accounts that you're putting on, and how many accounts are canceling each month. It's really important. It's kind of a simple report. You'd be surprised how many people can't pull that when we first meet them. Attrition, can you calculate your attrition? Can you get to the numbers that you need to get to those attrition definitions? Do you know why your customers are canceling? And, what things are you doing to, to mitigate the attrition? Are you successful with when accounts move? Are you able to successfully get them to re-sign? These are all the kind of things that we go through and look at when we're looking at an RMR deal. Another item is on the cash flow, just can you repay the loan, or at least the interest on the loan? You'd probably ask another banker in the room here, and well, we like outstandings. We like your loan to be outstanding, but we do like the fact that you're able to pay the interest on the loan. Other things that we look at is creation cost multiple. Are you creating your RMR at a reasonable rate? We understand that there's expenses and that there's some capitalized cost, and we take that into consideration when we look at your financial statements. But are you creating rate at a sustainable creation cost multiple, or would you be better off buying the rate because you're paying more to create it than you could actually buy it on the secondary market? We also look at the quality of your contracts. Are they industry standard in terms of kind of those key definitions that we look for, the key security language? And can you locate your contracts? Which box are they in? That's one of the things that Mark goes digging around for in Elko when they go out to do those exams for us. One of the things that we're looking for as we go through this process is we're kind of evaluating the depth of your information systems, your GL, your billing. Are you reconciling your billing information to your monitoring information? Are the accounts that you're monitoring the ones you're billing and billing the ones you're monitoring? All those things we're just kind of testing out to see, are you doing best practices? Can you get to the data that we need to really support the collateral that supports the loan? The other is the management team. It's really important for us to have a proven management team with sufficient depth to carry out your growth plans. We meet with a lot of companies, and it's great that they are where they are, but usually when they're looking for bank financing is because they want to make a large acquisition or they want to go to the next level. And one of the things that we look for is the management team that's in place, the team that can get them to the next level. And so that's one of the things that we talk through. For some companies, acquisitions have become a real area of expertise. For best results, we've seen companies create processes around acquisitions, a series of checklists and reviews that help you ensure that you're making a good acquisition, or at least not making the same mistakes that you did last time, or learning from other companies. When you come to networking events like this and hear what other companies have run into when they've made an acquisition, if you're learning from those mistakes and creating processes around it, those are all great things, what we've seen kind of the best of the group do. Other areas, clean telephone lines, the same things that you look for that we look for in your accounts are the same things that you're looking for when you go out to make an acquisition. The contracts, do you own your own phone lines? Does your acquisition own their own phone lines? Can you transfer it to your central station so you can benefit from the cost savings of having more accounts at a central? Companies who make regular acquisitions create an actual team around the due diligence process so that they can execute it very well. The companies that make acquisitions as just kind of a side where everyone has their own job to do, but now they also have to make an acquisition, it takes a really special company to make that work and for the management team not to get fatigued by that process. If you're making an acquisition once a year, that adds a lot of time to folks' schedules. So, right behind kind of paying top dollar for an acquisition, your reputation plays a huge role in who actually wins on a deal that goes to market. If you've treated people fairly in your last acquisition, that's going to pay dividends on the next one. If you burn your bridge as you go through and make acquisitions, there's not going to be anyone that wants to sell you anything. We all know that this is a very small community. Your reputation means a lot. So, just doing the right things is going to pay dividends down the road. But for those alarm companies that are seeking growth capital or acquisition financing, the roster of banks that know this space continues to grow. There's no shortage of banks that would love to give you money, especially the ones that have an understanding of this business, because it's a great industry to be invested in. And some of the best companies, I've been involved with over 150 fundings, issued over $1 billion in financing over my 18 years, and have done 70 acquisitions. And during that time, you meet a lot of companies. Some of the best are the ESA and CSA member companies. So being involved in a networking event like this is really gives you an edge. Your competitors that aren't here, they really miss out, because you have the ability now to call someone across the country to find out how they solved an issue that you might be having in your business without having to struggle through that on your own. So I think I've gone through my stuff.
All right.
I hope if anything else, that this validates what you're currently doing. And if not, maybe you add a few notes to your list so you can go back. So thank you. I'd be happy to take any questions afterwards.
Thank you, Jennifer.
Okay.
Next, we have Jeff Kessler. Jeff, you got to make your way around. No.
Thank you, Martha. And I don't have any slides as a member of a public of a company, as an analyst who covers publicly traded companies. I unfortunately would be up here for 15 minutes, literally giving compliance disclosures to you. You don't want to hear that type of language. I'll get right into it. Firstly, as an analyst who covers publicly traded companies, I have so that you'll come back to this table at the end and ask us questions. We've got a list of all my coverage here. I'm currently covering 10 companies, and that list is going to expand probably likely will double over the next year. And this list includes all the companies that have greater than, let's just call it, in one case there's $50 million. It's $100 million of market capitalization in the stock market, and at least 25 to 30% of their EBITDA in security. So a company like Stanley, makes the grade. And the current coverage list includes Ascent Monotronics, ADT, Checkpoint Systems, Brinks, Diebold, NICE, Stanley, Telguard, Verint, Tyco, and then we do shadow coverage on what I'm going to be talking about, which is some of the high yield bond issuers such as Vivint, Interface Security, and Securitas Direct. Yes, I actually did cover Securitas Direct back when it was public, and I still do cover them. I started out in 1983, kicking and screaming. I was given at Argus Research, I was forced to cover ADT, Sensormatic, and Checkpoint Systems. And in 1988, I expanded my security horizons a little bit, and I joined the august firm of Shearson Lehman Hutton, which eventually became the august firm of Lehman Brothers. in 1988, for one reason or another, I left Lehman Brothers and came to Imperial Capital as an investment banker. I switched from being an analyst to an investment banker for the last 5.5 years. I've actually been involved with John Mack and that group. We've done, obviously an awful lot of transactions in the group. About 3 months ago, I moved back into research, which is much more regulated, but it also lets me write a lot more, and that's what I started my career doing. On the other hand, I've been asked to talk about something that we've been involved in quite heavily, and that is the high yield market. I'm sure in talking about this, it's the first thing I have to say is that there are some cutoffs here, and there are some good things, there's some tough things about the high yield market. The good thing is that the high yield market for the last year and a half has been quite aggressive. Rates being where they are, we've seen not just us, and not just the security industry either, but we've seen a number of cases in which companies who could have securitized their assets going to high yield instead, simply because it offered a lot more leniency, a lot more flexibility than a securitization did. Also, in the case of, we'll go into the differences with the bank loan business as well. But one of the problems is that this really lines up with the types of companies that I cover, which is that if you're thinking of accessing the high yield market, generally you're looking for a minimum to get into the market, because below this number, the public markets don't care, and that's $75 to $100 million of borrowing and a minimum of $15 to $25 million of EBITDA, and that's unfortunately that's the size of the revenues of a lot of companies. But what we've seen, and a good example of this is if you are large enough to access the market, we saw that Ascent Capital, Monotronics, if you will, went 9 months through the securitization process, and in the end, they chose a high-yield deal. They chose the high-yield deal because while it was about 100, 150 basis points higher than the securitization, the covenant-light nature of it relative to the securitization was such that it's allowed them to have the flexibility to go out to the markets and say, we are now looking at other companies, we can do this, and we can do this, and we can do this. They could not have done that if they had just securitized, their recurring revenues at that point in time. Why do you want to get, if you're large enough, why do you want to be in the high yield market? Why? Because one of the things is the covenant levels. If you want to call it, you don't need maintenance covenants. We'll call it covenant light, if you will. It allows you the flexibility to not have to be under a microscope all the time. It's a form of permanent capital. It's effectively these deals go out long enough that it is now part of your capital structure, making it easier for you to deal with, again, the public markets. You have the advantage in a lot of ways of selling the story to public investors. By this time, the company has gotten to a point at which if they're trying to access the high yield market, they've made it through a lot of the hurdles that the loan market has already put them through. And now, instead of having them being every piece of RMR, every scrap of paper being ripped apart, they're telling a story out to a group of people who are going to invest in this company or not, with the knowledge that there really hasn't been, there have been, but there really hasn't been any major, let's call it major defaults that have screwed up this market in the last, let's say, at least in the last 5 years. The debt market has been strong. You can tell that story to the public. You can tell that story to the public market. The downside to this is that you get to deal with investment bankers and a lot more lawyers than than you would if you're going to your friendly banker. They're going to be there all the time, training you to tell the story and taking you from what was essentially a loan situation up to preparing you to potentially be on a call with your high-yield investors every quarter, where you just tell them what your results were. And we've seen a number of companies stumble in this because they never had to do this before. Why do I have to give this out to people? Well, they might not even know what you're talking about. You're talking about companies that invest in high yield, and as you know, there haven't been that many issuers in the security industry in the high yield market. It's just in the last couple of years that we've seen this. So teaching people the metrics, everything from creation cost to ARPU and RMR growth, to that crazy concept of steady state net operating free cash flow, which we've had to beat into their heads, and they still believe it's some crazy metric up in the heavens that doesn't mean anything, while they want to come back with us, which, give us the real EBITDA. Well, maybe we can't give, maybe EBITDA isn't commensurate between one company and another. Give us the free cash flow. Why isn't your free cash flow growing? Well, if your free cash flow is really growing, you may be shrinking. And these are the types of things you have to explain to those types of public investors. So that's one of the things that you have to go through. You have to go through, in many cases, a 144A issuer process, which includes a prospectus. It's almost like you're doing an IPO in effect. And again, the availability of the rate, and the coupon is going to be higher. We've seen most of these coupons in the anywhere from the high sixes to the high nines, depending on the issuer and depending on whether they're secured or unsecured. On the 4 or 5 big high yield deals that have been done, it is subject to the outside market forces, so that looking at the 10-year, in the back of your head and seeing when rates begin to back up, there may be a hiccup in the marketplace. It may be not so easy to fund this. It's like trying to do an IPO and telling somebody it's the market that's going to do it for you. There's no guarantee that in 6 months the market is going to be there for you. Right now, even with the rates having backed up, we've still seen a fairly strong, there's still strong market out there. And again, the problem here is that the companies that have issued it are all fairly sizable companies. And that is, knowing the audience that I have, I saw Jay Hahn out there, and he worked for ADT, works for Tyco now. He's part of the audience. Bottom line, though, is that if you do have the size and you want the flexibility to be able to have permanent capital, to be able to grow the business, and particularly, obviously, deal with a lot easier in some ways dealing with your private equity owners, having that flexibility is incredibly useful when you want to grow the business, particularly when you're looking at acquisitions. And with that, that's all I have to say.
All right, thank you, Jeff. All right. Thank you, guys. Oops. I'm going to go back to that. Questions? So if anybody has any questions, shout them out, raise your hands. I have a couple questions to ask these guys. And I guess I'll start with Jeff, because I know that Jeff has to catch a plane. He's been called back, so he has to run out a little early. But let's see. Here's a question for Jeff. How do you go about investing in a company, no matter how cutting edge or no matter how much recurring revenue they have, if they're still very entrepreneurial and come out with bills or purchase orders in a shoebox, something like that? How do you go about investing in a company like that, even if they're brilliant, but they're maybe not so organized?
Well, I think Robert just answered that for 15 minutes. I mean, bottom line is,
Can everybody hear? Yeah. Okay, yeah.
Look, I'll tell you what I do. I'm not the person in the end I'm not at the level at which we're going to be investing in that company. However, I've spent my entire career since 1983 looking at little companies and actually watching these little companies get to a point at which they can be sold, or at which they can, or which they can actually go public. The market that, number one, what is the market? What's the available market that they serve? Clearly, do they add value? What is the value proposition? Number two is, what's the value proposition that they bring to that large market? Is there a solution that this wonderful technology can bring to you, or can bring to another company, and still make a profit? We don't look at, when you have, one of the things that we've seen is I do a lot of bootstrapping work for our firm, and I did a lot for Lehman, where we go to alarm companies and do all the things that you talk about. And we've seen managements actually go through shoeboxes of POs and items like that. However, in looking at a company, when we in the public arena, or folks of us who would deal in the larger size private companies, when we've been at trade shows and gone through bleeding edge technology, again, what we look for is that technology applicable to a larger solution that is out there? Is it talking to this larger solution? If it's going to be a great piece of technology, then we have to make a decision of whether or not it is a product, or whether it is nothing more than a product that is part of a larger company, or is it a company that can develop, can develop an organic business on its own. It's very, very, very important. And finally, we take a look at whether or not clearly the management team is made up of the founder, entrepreneur, who may be a great CIO or CTO, and whether they've actually done that in these, and we're talking about product companies, and whether they've led, I can throw out names, but the bottom line is that there's a lot of companies have come to this spot in which they get to the $15 to $25 million mark, and they go through a management reconciliation type of situation in which they have to make a decision. Does that manager, founder, have the capability of making them a $50 to $75 million company? If not, then we've seen either trouble, or we've seen a lot of smooth changeover. Umpteen types of companies have seen the manager become the CTO and bring in somebody who either has access to the markets and understands the markets, the financial markets, as well as somebody else who has access to much larger and deeper pockets in the industry, so that they can make that decision with the company whether or not the company fits the larger value proposition we're talking about.
Okay.
Hopefully that's clear.
All right, so it's okay if you have a shoebox then, in some cases? All
And
your
you
stuff.
have to start, if you start out with a shoebox, it's okay. That shoebox just has to be able to have a value proposition inside of it that means something to a larger market.
Gotcha. All right. We have a question out there.
For Jennifer, with the increase in home automation and RMR being pushed up, what does your bank think of that? I guess I've talked to a lot of banks, and they're like, what's your average RMR? And when it starts pushing to 50, 60, almost up to $70, they're like, no, we're not interested in that. Just wondering what your thoughts are.
Yeah, no, that's a really good question, because when I started in the industry, we would look at RMR and say, really anything over $45, and you're just asking to be a takeover. You're a target. Yeah, that's before home automation. That's before all of the new app type technology that's out there. it has changed, and the specialty lenders are, moving with the change of the market. So you'll oftentimes find that there is eligibility up to a higher level of, is 60 the right number, is 65 the right number? I think it all depends on how the account was created. There's a process that goes to it, and one of those is just really sitting down and understanding as much as you can about how the account was created, how the RMR was created, and what the secondary market would pay for that. What's the value there? There probably is an upper limit, and you'll see in most cases there'll be in the eligible RMR, it'd be anything over that certain dollar amount would be ineligible, but not the whole contract. But the numbers definitely moved up from $45 it was many years ago.
I mean, I would just say this, I see a lot of data that correlates between the amount of services and attrition, and it's pretty highly reverse correlated. So, that $55, $60 a month RMR, if that's driven by multiple services, multiple interactions, now with the interactivity being hourly as opposed to monthly between the customer and that alarm company, we see very dramatic reductions in attrition associated with that level of interactivity. So I think it's just a question of getting the banks to understand what's really happening and why that value exists.
Yeah. One of the things that we've seen is over time, the margins of a traditional company offering just your standard POTS line, alarm monitoring, your basic monitoring, has really great margins, right? And so when you add on that interactive service, the cellular, plus the interactive, you're not really adding 80% margin on top of what it costs you. And so your margins are shrinking a bit on the overall account. And so that's why oftentimes when there is a sale, sometimes they'll exclude from the RMR on the purchase price the pass-through charges related to the cellular portion or the interactive portion.
We always deduct that.
There you go. There's a buyer for you.
That's your security network.
Some dealer programs are a little bit more lenient than others, but generally it's worked in there somewhere. For an acquisitive company, they're looking at what is my margin gonna be like buying this account base with smaller margins.
Okay. Robert, I wanted to ask you a couple questions about how much money, the size of capital that can be raised from various sources. If you can just give sort of the numbers, then if we're talking about angel investors, crowdsourcing, so can you just give those levels? Yeah.
So crowdsourcing, I think, you'll see it anywhere from 50,000 to $1 million. There's one example I have of a iSmart home. They raised 226,000 from 1,600 investors through crowdfunding sources. I see angel rounds, kind of anywhere from $250,000 to $2 million. The nice thing is, again, I think that the angel market is stronger and deeper than it's been in a long time, because there's been a lot of wealth created, certainly a lot of technology wealth created, and they're just really smart angels who want to actively be investing in companies where they understand the technology and they might be able to lend a hand. So I'd say angel rounds can sort of $250,000 to $2 million.
Okay.
So.
All right. And so you were talking about accelerators. How do I find an accelerator? I mean, is this something that that an alarm company, would they want to access? Would an accelerator be something that, small to medium-sized alarm company would be able to use, or is it really just a startup company would be?
They're usually very early stage companies where the concept or the business model, you know, is exciting. You see a lot of internet companies, a lot of internet kinds of concepts, so maybe a new social media launch or a subscription business. I will tell you though, I'm looking at this and mentoring this one startup security company where the founders have very, very strong domain expertise in events. They recognize that one of the biggest issues that they face from event to event, and major events, you know, New York Marathon, Boston Marathon, Olympics, that one of the biggest issues that they have and one of their biggest dollar spends was security.
Yeah.
And so they want to focus exclusively on bringing a host of integrated security solutions to major events. And that, as a fundamental business plan, got accepted to this accelerator that, again, you know, it's kind of a remarkable statistic that 85% of graduates raise $1.5 million or more.
Mm-hmm.
But if you're sitting in the shadow of Stanford University, it's pretty feasible.
Yeah,
So,
right.
but I would say you could find, I'd call any business school in any major market and ask them, are they participating in an accelerator, or do they know accelerators in their marketplace? Because it's pretty prolific.
Mhm. So if you were, say you were a traditional alarm company and you were kind of looking at, I don't know, some new technology or something, yeah, you were an entrepreneur, looking to sort of, I don't know, expand your business a little bit or do something a little bit different, or,
Yeah, you might see
Yeah.
a traditional alarm company that has, you know, has identified a real need, let's say, for very sophisticated sensors to integrate it to provide a level of home health care for, you know, specific disease states, and that as a business concept, maybe embodied to the second generation that's,
yeah,
you know, wants to build a business on their own. You could see that as a path, and rather than sort of drain cash from the traditional alarm business, you might get to an accelerator and help bring all kinds of technologies that exist out there to take that fundamental concept to a really important level. But make sure you can really work with a disease state. It's not as easy as I just described.
and also, you know, say I want to approach a venture fund. How do I do it? How do I get to meet these people?
I would say the best way is to, I'd say it's kind of one of two things. First of all, I would find a venture fund who is, in fact, again, the right audience. So a venture fund that's predisposed to investing in security, who has a track record of investing in security or homeland defense. And so you can immediately identify that particular partner who's involved with that investment, because they'll have a greater appreciation. It'd be very hard for a venture fund that didn't have previous exposure to go in cold. The best thing, if you can, is to find a law firm or an investment bank or a member of their advisory board who can walk you in and sort of have you pre-screened, if you will, to get the kind of time and attention that you deserve.
We actually do this. We actually do a lot of this. We have tons of companies coming to us, you know, who are in the $1 million, $2 million area. They want to get funding, and we can't deal with that. I mean, it's not our forte. However, we do know lots of people like Robert. I mean, and we do know lots of venture funds that are friends of the family, so to speak, who we would bring that over to.
Okay. So you can provide those introductions. And then just one more for you, Robert. If you're an entrepreneur and you know, you're dealing with these different kinds of financing partners, are there certain things you need to expect? Certain, you know, when you're dealing with you know, the crowdsourcing folks or the angel investors that you need to think about what your relationship might be like.
Well, I'd say this with the angel investors. I think typically you find more and more angel groups geographically organized, and so what you'll find is you want to find one person, ideally in that angel group, who's going to be responsible for you, because angel investments typically will have, you know, 10 to 20 participants, and you as an entrepreneur don't want to deal with 10 or 20 different investors saying, how are things going this month? So I think you want to make sure you get everybody on the same page, say, okay, this is the person who's going to represent the angel group, this is who I'm going to interact with. If you have some special skills, I'll talk to you. If not, please talk to your angel rep, because it could be
Yeah.
it could be a nightmare.
Angels everywhere, right? So-
Angels everywhere.
Hell's
right.
Angels, maybe, yeah. Okay. Jennifer, another question for you. What are the most important things when you're preparing your business, preparing to, let me see, which one am I going to ask you? Prepare your business if you're seeking a line of credit through you guys. What do they need to do? What should, I'm getting ready, I need a line of credit, I need to talk to you. What should I do first, other than make sure,
Sure.
get it out of the shoebox, right? And then,
Sure. I guess the first thing I would say is, it's probably never too early to at least get to know a couple bankers, because you don't want to be, even if you have all of your ducks in a row on terms of your collateral, your RMR, your cash flow, you've got a great management team, even if you have everything, all your ducks in a row, you don't want to be going in cold, meeting your banker for the first time. You need to have built this relationship. Over the last couple of years, at least that's important to private bank. It might not be important to others, but we bank with people that we know, and there's companies that I work with for years before there's a financing event that causes them to seek out additional money that would cause them to come to us. But during that time, there's a lot of great discussions. We're involved in their business as much as, they ask, what do you see? Because when you're running your own business, a lot of times you don't have the wide view of how do I compare with my peers. And so, just keeping up with, I've got companies that send me their annual financials, not their monthly financials, but like their annual financials, and we'll go through them together and give them, some feedback. And that's when, we sit down, we have conversations, and so they can kind of see, what is it that I should be doing differently? What is it that, whatever's going on in their business. It helps to know your banker before you need money, is what I'd say. But collateral, cash flow, the character of the owners are all super important things, in addition to just having your financial house in order.
all right, thanks, Jennifer. And also, if you're seeking bank financing, and you were talking about, working with, there are more and more banks that are getting into, specializing in security. What if they don't specialize in security? Is there, here's an opportunity for you to tell me why you need to go to a bank that has a security division, or,
Yeah. I would be, I would probably be a little leery about being an outlier in your bank. So if you have a local bank and you're really the only security company they do business with, and, you're it, or you're with a specialty lender, but you're the smallest loan, or you're the biggest loan, that probably wouldn't give me much comfort level, because, banks, sometimes when things get rough in the banking industry, you see, and it's happened before, is people pull in. Let's just focus on our core, just like security companies do. And when times get bad and you're in 10 different markets, you just kind of focus in on the core. Well, the outliers are, may find themselves in not a great position. So that's probably something I would be concerned with. If you were an outlier within your bank, just get to know another bank.
and if you're an outlier.
I would think so.
Yeah, it's,
Yeah.
you're not going to be surprised.
Right.
Yeah, okay. Does anybody have any other questions for any of our panelists? Yes.
So, on do-it-yourself install, very popular. What have you guys seen with lending on those accounts? Do you look at them any differently than you would a traditional account, or have you seen large fundings on those sorts of accounts?
The DIY market is a proven market. You're seeing, several years ago, 8, 10 years ago, it was kind of the new thing. But now you're seeing all kinds of companies in the DIY space. Protection One has a DIY. I'm not telling you anything that's not public. It was, they have a line a channel that they buy DIY right through. There's several of the larger companies that have a DIY channel. So it's no longer, really that unique, just one more channel. There's some different things that DIY is a tough nut to crack, though, from an operations standpoint.
Do you like to see both? Do you like somebody to have a, sort of a traditional company also doing DIY instead of just a DIY straight? I mean, I guess there aren't too many, big
Yeah.
ones out there, but.
So the DIY market is interesting. I mean, it's a very, it takes a lot to do that market right, and that's probably why you see Protection One's not doing DIY. They're buying from someone who does
Yeah.
it. It's probably difficult to do that channel yourself and your normal residential and your commercial.
Yeah.
It's a special.
We were involved in Protect America 3 years ago. We represented them, and the problem is, again, you're talking about the largest one in the whole industry, and they got a reasonable multiple from a firm, Rockbridge, out of Detroit, which also owns Quicken Loans, who had an idea about cross-selling alarms with loans and other consumer products, which has worked. But I'm not going to tell you that is typical of the DIY market. We've just seen another interesting situation happen with Life Shield, a DIY company which happens to have its business monitored by CMS at this point. They're being bought by DirecTV. And again, I don't know the numbers on that. But it is companies that have proven themselves out in the marketplace. I would say get a slight discount, because it's DIY and because there is a tremendous amount of hand-holding that has to go through the company to the end user to make sure that end user stays with them in the first week or so. And then after that, it's pretty much, how good is the monitoring. So that's the bottom line is that the largest company got a reasonable multiple in the marketplace.
All right. Any other questions? All right, I want to thank you guys very much.
Thank you.
Jeff and Robert and Jennifer, thank you very much. Everybody, thanks for coming.